ASML just reported earnings, and as a shareholder, there's one specific number in this report that most people are completely ignoring. It's the reason their global monopoly actually just got stronger despite what the headlines are saying. Today I'm breaking down the raw data and showing you exactly how I'm updating my valuation model and whether I'm buying more at these levels. Since the start of 2026, ASML stock has done pretty well. It's up 36%. That's the best performance out of any stock in my portfolio. It's also the second best performing stock on my watch list year to date. And that 36% gain looks especially impressive when you compare it to the S&P 500, which is only up 4%. So how come ASML is up 36% while the rest of the market lags behind? Well, you see, ASML is at the end of an incredibly profitable supply chain. Demand for artificial intelligence compute has skyrocketed. If we just take a look at this chart, you can begin to understand just how insane the current AI spending boom is becoming. Here we have the capital expenditures, basically the money being spent on AI compute, of the 4 big tech hyperscalers. These hyperscalers include Alphabet in red, Amazon in orange, Meta in blue, and Microsoft in green. Between them, they spent nearly $400 billion in the past 12 months buying mostly AI chips from companies like Nvidia, and that spending is only expected to rise even further over the next couple of years. That's why we've seen Nvidia's revenue along with its stock price skyrocket over the past 5 years. Much of that extra revenue that Nvidia is bringing in comes directly from capex from the hyperscalers. But where does this leave ASML? Nvidia doesn't manufacture their own chips. They outsource that to foundries like TSMC. TSMC are the geopolitically crucial company that produces most of the world's advanced chips in Taiwan. But how does TSMC build these chips? By using ASML's lithography machines. ASML is the only company in the world that can produce commercially viable, extreme ultraviolet light, or EUV machines. These machines are like the ovens that cook up the world's most advanced chips. This monopoly position in EUV even allowed them to take market share in the less advanced DUV machine market. So with that said, let's take a look at ASML's latest earnings to see just how strong the company is becoming. In Q1 2026, total net sales were 8.8 billion euros, in line with guidance. ASML report in euros because the company was founded and is still based in the Netherlands. Installed base revenue was 2.5 billion euros, slightly above guidance. This is the money ASML made for servicing the machines it already has in foundries all over the world. This installed based revenue is something that I pay close attention to as an ASML shareholder because it's actually more profitable than the sale of the machines themselves. To sell the machine, you have to buy hundreds of thousands of parts, put them all together, then take them back apart again, put them on multiple Boeing 747 planes and fly them to the foundry location, and then put the machine back together again with no errors. But to service the machine, the company has long-term agreements and may only need a few hours of labor and some spare parts. And that's why the company's gross margin came in at 53%, at the high end of guidance, supported by a favorable mix and high margin installed base components. They just said it there in black and white. That favorable mix means more installed base revenue as a percentage of sales. Net income was 2.8 billion euros for the quarter. And then the company gave guidance for the quarter we're currently in. They expect total net sales of 8.4 to 9 billion euros. Installed base revenue is again expected to be around 2.5 billion euros, and gross margin guidance for Q2 is between 51 and 52%. So a slight decline in gross margin due to the installed base revenue staying flat and other less profitable revenue sources such as selling the machines themselves growing. Then the company gave its full year outlook for 2026. 2026 is characterized as a very strong growth year. Full year net sales outlook was narrowed and raised to 36 to 40 billion euros. So full year revenue is expected to come in higher than previously thought due to the rising demand for advanced compute. EUV, both low NA and high NA, is expected to be strong in 2026. Non-EUV business, previously expected to be flat year on year, is now expected to grow, including immersion, dry systems, and applications. So demand is even rising for their less advanced DUV machines that we mentioned earlier. Installed base business is expected to show strong growth as customers use upgrades and services to quickly add capacity. Now this is really bullish. That high margin installed base revenue is what we want to see growing faster than any other revenue segment because it increases the company's overall profit margins. It's more predictable as well. These long-term service agreements are like software subscriptions that you can't afford to cancel because otherwise the ovens that cook the chips will stop functioning at full capacity. Management believes the 36 to 40 billion euro revenue range can accommodate potential outcomes of ongoing export control discussions. This is ASML saying that even if export controls get worse, their 2026 revenue target is still achievable. ASML's most advanced EUV machines are restricted from being sold to China. Even though it's a Dutch company, the US government wanted to make sure that the world's most advanced technology doesn't fall into the hands of a potential adversary. Full year 2026 gross margin expectation remains at 51 to 53%. Then the company goes on to give us some detail about the wider industry. Semiconductor industry growth continues to solidify, largely driven by AI infrastructure investment. Strong demand for advanced memory and advanced logic to support AI, mobile, and PC applications. ASML expects supply will not meet demand for the foreseeable future, creating persistent constraints in end markets. These supply constraints could signal rising prices for ASML's machines. If demand persistently outweighs supply, ASML could raise prices to increase their profit margins. They could then use these extra profits to invest in supply chain improvements so that they can meet higher demand in future. Memory customers report they're sold out for 2026, with supply constraints expected to last beyond 2026. So not only is ASML supply constrained, but so are their customers. Memory chip producers like Samsung, SK Hynix, and Micron are all struggling to meet explosive demand for memory chips. You can see the impact it's had on their stock prices, with Micron up 59%, SK Hynix up 72%, and Samsung up 86% just this year. Advanced logic customers are building capacity across several nodes and ramping 2nm to address AI-related products. When ASML says advanced logic customers, they're referring to TSMC, Intel, and Samsung. ASML are suggesting here that these companies are also investing in their supply chain to meet AI-driven demand, which means more of ASML's advanced EUV machines are needed. Then we have some commentary specifically on how ASML customers are investing to meet demand. Memory and logic customers are increasing capital expenditures and attempting to accelerate capacity ramps in 2026 and beyond. Many of these capacity additions are backed by long-term commitments from their own customers. So these investments by ASML's customers are quite low risk because they already have financial commitments from these customers to utilize the extra capacity. Both DRAM and advanced logic customers are increasing adoption of EUV and immersion lithography. This drives higher litho intensity, more lithography per chip, and therefore higher lithography demand for ASML. So ASML is suggesting here that their products are becoming more important in the production workflow of their customers. ASML is working closely with customers to expand its own capacity in 2026 and will continue doing so through 2027. So as much as these long-term investments will likely have a high return for the underlying business, the market might not reward the stock because ASML spending will increase in the short term. Now we have some actual numbers for ASML's capacity expansion and shipment plans. ASML aims to ship at least 60 low NA EUV systems in 2026. DUV immersion demand was initially assumed to be significantly lower, leading to a slow start in 2026. Demand for immersion has since reversed higher, despite the slow start. ASML expects 2026 immersion unit sales to be close to last year's level. For 2027, ASML is increasing its move rate quarter by quarter to expand capacity. Their move rate is essentially how many machines the company can build and ship. If customer demand underpins it, ASML expects to reach at least 80 low NA EUV units of output in 2027. Non-EUV capacity, including immersion, dry, and other systems, are being aligned with customer needs across nodes. And then they go on to speak about the progress their technology is making, how their customers are happy with the gains in efficiency that ASML is providing. We won't go into detail here because, to be honest, it's not that relevant to the ASML investment case. Not that the technology improving isn't relevant to the investment case, but that the discussion is more technical in nature. Right, now for your favorite part of the show, valuation. ASML trades at a market cap of $560 billion with a forward price to earnings ratio of 36. When you adjust for what analysts expect 2027's earnings to look like, the price to earnings ratio falls to 29. This doesn't necessarily mean the stock is overvalued. Businesses of ASML's quality can trade at between 30 to 40 times earnings for long periods of time. Over the past 10 years, the stock has traded for as little as 20 times earnings and as much as 65 times earnings at the peak. This is based on the last 12 months, so it's backward looking. However, the stock currently trades at a high point of almost 50 times earnings. Again, if future growth is higher than expected, this might not be as overvalued as the PE ratio suggests. On a free cash flow basis, the stock currently trades at a 1.8% yield. For most companies, that looks expensive, but ASML will trade at a premium valuation more often than not. Over the past 10 years, the stock has traded for a free cash flow yield as low as 0.7% and as high as 6.75%. The higher the free cash flow yield, the lower the valuation, and vice versa. Now let's go over to the DCF calculator and build our valuation model for ASML stock. Rather than cash flow, I'm going to use earnings to value ASML stock because ASML's free cash flow can be lumpy and unpredictable due to the nature of their product. First, we have to decide what growth rate ASML will achieve over the next 5 years. As we saw from their earnings, demand is off the charts for their machines due to the AI boom. This has to play a role in our thinking. AI is a powerful tailwind for ASML. If we look at this chart of ASML's earnings per share, we can see their 10-year growth rate is 25%. Very strong growth for a company at the size of ASML. The growth rate has decelerated to 19% in the past 5 years, and in the past year it's decelerated to 17%. With the AI tailwind that ASML is experiencing, I doubt EPS growth will slow any more than it already has. We could even see an acceleration over the next 5 years. For our model, I'm going to assume that ASML can grow earnings per share at 18% annually in the next 5 years. Now we have to decide what PE multiple ASML stock will trade at. As we saw from the chart of ASML's 10-year price to earnings ratio, the multiple can be volatile due to the cyclical nature of the business. But with the growing installed base management business, I think the company's revenue is becoming much more predictable over time. If we draw a line across the midpoint, ASML bounces around a 35 PE multiple. So if we plug that number into our valuation model, you're looking at a 10.8% annualized return from ASML stock over the next 5 years. I certainly wouldn't say that the stock is overvalued right now, but it isn't undervalued either. So I suppose we should call it fairly valued. I won't be selling any of my ASML position, but I won't be buying any more unless the stock gets significantly cheaper than it is today.